policymakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, a crucial Fed meeting begins today. Ahead of it, an appeals court blocked Donald Trump from firing Lisa Cook as she challenges her dismissal from the Fed. Now, while the Senate confirmed Stephen Miran as a governor, that means governors could be involved in the meeting, both of them. Outside of the Fed, President Trump says he'll speak with the Chinese President Xi on Friday after reaching a consensus on TikTok. And domestically, Trump is also pushing to reduce the frequency of corporate earnings reports. So there's a lot to discuss with Isabelle Mateos, Lago, Group Chief Economist at BNP Paribas. And then in a second, we'll also speak to Ross Matheson for everything to do with the SEC. And then we'll speak to Ben, of course, in Madrid over China. Now, Wall Street's main regulator said it is prioritizing a proposal for Donald Trump to reduce the frequency of corporate earnings. But away from that, Isabelle, a lot of the focus, actually all the focus is on Fed. Right? Are we expecting, the market is now pricing in a lot of cuts before January. Is that how you're seeing it?
So, good morning.
Good morning.
Great to be here. So, yes, the market is expecting that the Fed is going to respond to the slowing down in job creations by delivering sequential rate cuts, and we pretty much agree with that call. And that, of course, would be a pivot from the June positioning, which was very much emphasizing we'll do whatever we have to do to fight inflation. So, but the motivation of that decision will be very interesting, as well as how the dot plot shapes up.
But Isabelle, why not go for 50? So the market is expecting 25 and then a series of cuts. Is there worry about inflation? Because if you're not too worried about inflation and you look at deteriorating labor market, go big.
Right. Well, maybe one of the FOMC members will make a case for 50, but let's not forget it remains a balancing act. Inflation is accelerating. It is moving away from target. It is now much closer to 3% than to 2% and rising. And I think there's a consensus to expect this acceleration to continue as the impact of tariffs gets passed through increasingly. And so the question is, how quickly is the labor market slowing down? We know that there's been a massive slowdown in job creation, but we also know that there's been a slowdown in labor supply. And so the unemployment rate is actually not far at all from what is believed to be its long-term equilibrium rate, which is 4.2%. It is at 4.3%. So I think it makes sense for the Fed to tilt a little bit its posture towards paying attention to employment, but it's not as if it can take its eyes away from the inflation ball.
So, Isabelle, overall, what's more perplexing? The fact that it does seem like, the labor market has deteriorated quite quickly, or it seems like we're at a standstill. And I don't know whether it's expectations, it's animal spirits, or it's a little bit wait and see, or is it more perplexing that inflation is where it is?
I really think the Fed has to pay close attention to both sides of its mandates. Now, when you look at all the data that we have on the U.S. economy, you see two things that are showing signs of slowing down perhaps a bit faster than would be comfortable. It's the labor market and it's the housing sector and construction. But all the other signs about the economy, or be it, consumption, retail sales, industrial production, business confidence, all of that is not signaling that there is a problem or a risk of recession. And so, again, the supply shocks that this economy has been exposed to, be it from tariffs, be it from the crackdown on immigration, the whole economy has to adjust to that. And that means the Fed has to move very cautiously. And again, in a very balanced way between the risk to employment and inflation. I think that's what it's going to do.
Isabelle, I want to talk to you about central bank independence, but also the other big story is Wall Street's main regulator said it's prioritizing a proposal from Donald Trump to reduce the frequency of corporate earnings report after the president again stepped into a long-running debate over transparency in American capitals. Our very own Ross Matheson is here. Ross, this took many probably by surprise, but a key Wall Street change could be coming. And this really changes everything. If you end quarterly reports, probably a lot of CEOs will be cheering, but it changes the markets completely.
It could. And of course, Donald Trump has floated this before and regulators have looked at it a bit before. Here we are again, and the SEC is going to prioritise having a look at this again. As you're saying, there are pros and cons. You can see that some companies would be thinking, terrific. They say it's a burden, it costs money. It also causes short-termism. People focus very much just on what's in front of them. Investors can go down rabbit holes on stuff that is very short-term. On the other side of the coin, quarterly reporting came in for a reason, which is transparency, and to allow investors to have a very clear sense of where a company is going. I mean, Donald Trump will say, well, other countries around the world have different requirements. Look at China, look at Europe. I mean, many companies in Europe are not compelled to report every quarter. Many of them do. They choose to anyway. And in the environment that we're in, where the world is changing very quickly around us, policy making is changing very quickly, company outlooks can change very, very quickly. And so the argument would be there that quarterly reporting at least gives a sense of where a company is going in a very fast-shifting global landscape around things like trade and investment.
Roz, I mean, the other big story is that basically Donald Trump is suing the New York Times for a very large amount of money. What are the implications of that?
Well, he does have a history of suing media outlets that go back many, many decades, and he's had success with that, and he's also had failure with that. Of course, he's in the middle of suing News Corp over an article in July which was alleging that he had sent a suggestive birthday card to the deceased sex offender Jeffrey Epstein. He's got that lawsuit going at the moment. Now he's suing the New York Times in Florida, interestingly, for more than the market cap of the New York Times. And it seems to be a broad allegation here. It doesn't seem to involve specific articles or one specific report that was made, but that the New York Times has an agenda against him and against his administration, and that collectively the body of work the New York Times is producing is about sort of being a mouthpiece for the Democrats. And so where it goes or how long it takes remains to be seen. Obviously, it's a massive amount of money that tends to get changed in the minute. And some of these media companies have settled with him before. But it seems to be different this time because it's not about a specific article or an opinion piece or something. It's more just about saying there's an agenda by a news organisation. So obviously potential ramifications from that.
Roz, thank you so much. Roz Matheson there with the very latest, of course, on the Trump administration. Isabelle, I guess the Trump administration is pushing boundaries. And I don't know whether this has an implication on the wider economy. For example, when it comes to central bank independence and what they're trying to do with Lisa Cook, it's probably just a victory in their eyes that at some point she has to go. The market is largely ignoring it. But does it change the way policy is made in the U.S.?
So first of all, I'm not sure the market is ignoring it. I think the market is looking very closely at the developments in that space, and I think the market is going to look very closely at the answers that the chairman gives at the press conference tomorrow to get a sense of whether the decision that is made by the FOMC is at all influenced by politics and the attempts around Fed independence. My expectation is that he will do his utmost and will be convincing in explaining that the cut that they almost certainly will announce is directed by economic data, and that they will continue to act in this way. But I think the market is watching this development very closely. It's true that you would say, well, if the market were worried about Fed independence, you should see more an inflation risk premium, you should see a steeper yield curve. But the market is also pricing a lot of other things happening at the same time, including the slowdown in the labor market, etc. So I think it would be a mistake to say, oh, the market is ignoring the risks around Fed independence.
But, overall, Isabelle, I mean, I guess the question is there a market belief that whoever then becomes either a governor or the chair will follow economics rather than political influence?
Well, so far you have to assume that this is going to be the case. But as I said, markets are paying close attention to this, and any hints to the contrary, I suspect, will have an impact on market pricing, particularly in bond and FX markets.
Okay, Isabelle, thanks so much. We'll get back to that, of course, and we'll talk a little bit about China. But President Trump says he'll have a phone call with China's Xi Jinping on Friday after officials meeting in Madrid reached a framework deal on keeping TikTok app running in the U.S.
I'm speaking to President Xi on Friday for confirmation of that, and, frankly, more importantly, a big deal. And we've had very good meetings. As you know, we were in Europe, our people, Scott Bessent and Jameson Greer and others. And it was a very big meeting with China. And, they're treating us with respect. We treat them with respect, too. But it was very successful.
Well, our Ben Sills is in Madrid. Ben, were these talks mainly about TikTok in the end?
It does seem to be that's the case. I mean, obviously there was a lot of speculation that they'd be addressing the broader trade issues between the US and China, but it's certainly in terms of the deliverables, that seems to be the main thing that's come out of it this week. Yeah, absolutely.
And Ben, what can we actually expect from the call between President Trump and President Xi?
Well, I think the first thing we want to try and get out of it is a sense of what's in this deal. We don't really know what the so-called framework agreement will mean, how the US will be able to address the national security concerns relating to TikTok, how they'll be able to make that palatable to the Chinese. So the first thing we'll be looking for is details of that. And beyond that, we know Trump is aiming to have a face-to-face meeting with Xi Jinping in the next few weeks. And I think they'll be looking to lay the groundwork for that meeting to go ahead.
Ben, thank you so much. Ben Sills there in Madrid with some big news, of course, on US-China and the way forward in that relationship. Still with us, Isabelle Mateos Lago from BNP Paribas. Isabelle, I mean, how do you look at China right now?
China is slowing down. The news on Monday showed a broad-based slowing in economic activity. And frankly, it may be one of these cases of bad news is good news. Because I think it's showing, including to the Chinese leadership, the limits of a growth model that has led to overinvestment and overcapacity. And that finally, we think the right kind of stimulus might be coming through, excuse me, to support a rebalancing towards consumption and end this kind of constant oversupply, overinvestment, which has led into a bit of an impasse. So big slowdown, and we expect now a more deliberate effort to boost consumption, which could be a relief for the rest of the world, frankly.
I mean, I get the million-dollar questions is with President Xi and President Trump speaking on the phone on Friday. Does it mean anything for the economy longer term, or actually because it's so uncertain, the relationship the two men will have, it doesn't? You can't really translate into an optimism for markets.
So I think the market expectation is that the trade relationship is going to remain broadly where it is, in other words, with very high tariffs, which imply a much lower level of exports from China to the US, but nothing very disruptive, except for the fact that so far China has been very successful in redirecting its exports that used to go to the US to the rest of the world, and in particular to Europe, but also to ASEAN, and putting a lot of downward pressure on export prices in these areas. So it's a question that is important for the entire global economy, not just for the bilateral relationship. But I think that the base case is they're going to find a way to effectively reconduct this sort of truce with tariffs at the current level, no major improvement nor deterioration.
Isabelle, what have we learned about tariffs so far? There's a lot. I mean, there's a lot because there's also this case, and we're unclear whether it's legal and lawful. But they're more deflationary than maybe initially some economists thought.
I'm not sure I would agree with that. I mean, first of all, it's early days because the tariffs, are not yet fully in place. Yeah. As you mentioned, there are some legal challenges underway. We're still waiting for the outcome of the Section 232 investigations, which will be very important for pharmaceutical products, semiconductors, other products, which for some countries are the bulk of their exports to the US. But actually, what we've seen so far is it's been a headwind to the U.S. economy. We've seen the U.S. economy really decelerate. We've seen employment and activity indicators in sectors impacted by tariffs slow down more than the others. Whereas in the rest of the world, the picture we're seeing is a picture of resilience. Mm-hmm. Why? Because trade has been redirected by and large away from the U.S. to the rest of the world. And as well, other economies have taken steps to support their own economy. But what I would say so far, if anything, is surprising resilience of the global economy to this tariff shock.
Where does Europe sit in this?
Well, Europe is in a very good place. I mean, as I'm sure you noticed, the ECB revised its growth expectations for this year quite meaningfully by 30%. Just last week, we are even more optimistic now. We think growth this year could reach 1.3%, and we see this as, frankly, an acceleration process that is going to continue, thanks to mostly thanks to the extra investment that is taking place out of Germany and to a lesser extent in the rest of Europe. But this is a very clear sign of a continent that has been energized into adopting, good self-help policies in response partially to the tariff shock.
But do you worry about France in particular? I mean, given the ratings, given what we heard on Friday, and the inability or complexity of finding a budget?
Yeah, so France has been a little bit, for domestic reasons, lagging behind the rest of the Eurozone in terms of this accelerating growth momentum. Having said that, even France has surprised to the upside. Both the Banque de France and INSEE revised up their growth projections for 2025 just last week. So we're not looking at 0.7, 0.8, depending on whom you believe. And so, sure, now there's a return of heightened political uncertainty, and there is a need to do some proper fiscal consolidation, and that's going to be a headwind to growth going forward. However, we're pretty confident that a compromise can be found with the new Prime Minister reaching out to, both the left and the right. It's not an insuperable problem, frankly. Probably the scale of consolidation that the previous Prime Minister had in mind, around 44 billion euros, close to 1% of GDP, that was too ambitious. We think, you could aim for around 0.5% of GDP of consolidation over the next few years, and that this is something the political system could stomach. But obviously, these decisions are very hard, and somehow they're only ever made under pressure. But I think we're now at a space where, and the French economy remains strong, remains dynamic. We're in fact seeing a return of positive job creation, positive business creations. The aeronautics sector, which was impacted by supply problems in previous years, is back on track. So I don't think we should be overly pessimistic about France, but it's true that it's been lagging behind the rest of the Eurozone.
Isabelle, thank you so much. Isabelle Mateos, Lago, there, Group Chief Economist at BNP Paribas. Now, coming up, Trump's state visit may provide a brief diversion for Keir Starmer amid calls to replace him as Prime Minister from his own party. We'll have the details next, and this is Bloomberg.
I think you always have the comparison between different points in time, and they're more balanced now. And personally, I think they are quite balanced in terms of upward and downward potential of inflation.
Well, that was the ECB Governing Council member Martin Kocher. Now, during his trip to the UK, Donald Trump is expected to announce economic deals valued at over $10 billion. Google has already announced a £5 billion AI investment in the UK ahead of the state visit. Now, the state visit comes at a politically tense time for the Prime Minister, Keir Starmer. For more, I'm joined by Alex Morgan and Kit Rees, editor of Bloomberg's Markets Today. So thank you both for joining us. I'm quite excited about the pageantry. There's going to be, the royals in full view. But this comes at a really delicate time, Alex, for the Prime Minister, because there are so many calls within his party for him to resign.
Well, it's feeling quiet, isn't it, Francine, UK politics? Feeling quieter to you than 14 months ago? Obviously, it's not. And that was the key premise upon which Keir Starmer's election campaign was based, wasn't it? He was going to restore a sense of calm after 14 years of Conservative rule. Here we are, 14 months in, and he has lost his Deputy Prime Minister, his Deputy Leader, Angela Rayner. He's also lost, of course, having sacked the US ambassador following that Bloomberg News investigation into connections between Lord Mandelson and Jeffrey Epstein, which went on longer than originally thought. And he's also lost his head of strategy now. So Keir Starmer, having tried to reset the government, version 2, as it were, after a difficult summer, is now what we call this version 3. I mean, it's a really noisy time for him, as you're saying there. Maybe the state visit bringing some sort of respite. The eyes will be on, of course, the US-UK relations rather than the turmoil within Downing Street itself.
So what can you tell us about who could replace him? We want names, Alex.
Well, names. And Francie, this is a really tricky thing. There's actually a brilliant article today by our colleague Alex Wickham saying that the one thing keeping Keir Starmer really safely in place is the fact that nobody really knows who would replace him. I mean, that's extraordinary when you look at the fact that, just, as I say, 14 months ago, we were talking about this broad, albeit shallow, Labour landslide. So it's quite a shallow vote share, but a broad sweep of the board where they looked, really a commanding lead. Now we're talking about Operation Save Keir, according to some insiders, number 10. Now, who could replace him? Well, of course, the Labour left have been agitating for the government to take more of a left wing, less of a centrist position. But in terms of names, I mean, it is really difficult, of course, because as our colleague Alex Wickham is saying, there really isn't an obvious successor. Now, for Keir Starmer and his team, who, of course, have now been looking to reset after a reset, that's good news. But the Prime Minister is looking vulnerable at the time, and, of course, he's wanting to project strength in front of the US President.
I know. I mean, I never actually envy central bankers, but I feel like today maybe the Bank of England governor has an easier job than the Prime Minister. Kate, what can you tell us about the jobs data and the fact that a lot of economists think the BOE are now, done cutting?
I mean, I'm sorry to disappoint, but I don't think the wage growth data is actually going to move the needle in terms of what the Bank of England might be thinking. So, we've seen it moderate, but it's still probably a little bit too high for their comfort. I mean, there's a massive focus on inflation. The Bank of England wants to get it down to 2%. And so we're going to be getting tomorrow's data, and we'll see if it indeed has done. It's not expected to. The print is expected to be at 3.8%, so still uncomfortably high. And again, this means that markets have been kind of pricing out another rate cut this year. So they're expected to keep rates on hold at the meeting on Thursday. And November is also looking less and less likely. So still a lot of uncertainty in the economy. Obviously, they don't want growth to stagnate while inflation remains high. But, we'll have to get a few more data points to get, a firmer read on that.
Yeah, and Kit, what are some of the concerns that the BOE has raised recently? I know, they have the tariffs to contend with the U.S. There's a lot of, trade concern. At the same time, a lot of it is actually self-inflicted by the government.
I mean, that's very true. I'm sure they're taking all of those things into account as well. I mean, one thing is it's just really all about inflation. They're worried that it's just been persistent, it's very stubborn, and, we've had some of the more hawkish members, like the Deputy Governor Claire Lombard-Delli, also flag concerns that food prices are high, and this is obviously very much more salient for consumers in terms of, inflation expectations, how households must be spending. So it's all about inflation and the labour market for now, and that's probably what it's going to be for the foreseeable future.
Okay, I mean, at least, if you're the Prime Minister, how do you define success in the week where Donald Trump comes to town?
Goodness me, I think, do you know, there's a talk of this press conference, which of course will have between Keir Starmer and Donald Trump, where it's said to be giving Downing Street aides nightmares because the awkward questions over the sacking of the US ambassador, Lord Mandelson, around those Jeffrey Epstein ties you mentioned from the Bloomberg investigation, what's said to be giving them nightmares is the idea you'd have Trump there, of course, who has himself been trying to distance himself from that story, to minimise that story in the US, and Keir Starmer to his side being asked repeatedly by journalists those kind of questions. So success, maybe Francine, is avoiding awkward moments.
Yeah, no awkward moments, maybe a couple of deals. Kit and Alex, thank you so much. Kurt Rees and Alex Morton. Coming up, we'll talk a lot more about the Fed and the impact on emerging markets. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Stocks hit a new record as investors bet on a Fed rate cut tomorrow. President Trump's governor pick, Stephen Miran, is confirmed, but his bid to fire Lisa Cook is blocked. The SEC says it's prioritizing Trump's proposal to reduce the frequency of earnings reports after the president called for an end to quarterly disclosures. Plus, Google announces a £5 billion AI investment in the UK as President Trump prepares to unveil billions of dollars of deals during his state visit. So the Federal Reserve policymakers begin their next meeting later today, but exactly who will be voting was still up in the air with just hours ago. Now, Donald Trump's Fed nominee, Stephen Miran, was also confirmed to the board by the Senate last night, paving the way for him to join the meeting. But his bid to fire Lisa Cook from the board was blocked by an appeals court, meaning she too is set to vote. Well, let's bring in John Authers. Bloomberg's senior editor for markets and Bloomberg opinion columnist. John, thank you for joining us. I mean, there's a lot going on. What are you expecting, us to be talking about post-Fed?
Well, I think we're most likely to be talking about a 25 basis points cut, and we'll be most interested in what they've said about the future. In terms of the drama around this meeting, everybody now assumes that Stephen Miran will dissent from whatever the majority of his colleagues have said in a more dovish direction. And obviously it'll be interesting to see exactly how vocal, how strong-worded that dissent is. He has accused his new colleagues of tariff derangement syndrome in the recent past, so that will be the soap operatic element of it. For the future of the Fed, everything is about Lisa Cook, and at this point, and the date that matters is next February, when the Fed governors, the 7 who sit in DC, have the option of vetoing people who've been put forward to run the regional Feds, which is ultimately the moment at which it might be possible to gain a majority of the overall FOMC. That would absolutely require Lisa Cook to be replaced by then, and that's where the end game is. I think this has been a power play trying to get her off the committee as soon as this week. It doesn't surprise me that she wasn't being given adequate due process, according to the courts.
John, I absolutely love your column today, right? Because it's basically, the drama over who votes you think has profound implications. And that's probably the biggest question, exactly who will be voting and how and everything.
Yes.
Why do you think the markets are not pricing in a jumbo cut? Would it be the right thing to do, 50 basis point cuts, and then let's revisit?
But I personally don't think it would be the right thing to do, because I tend to be relatively hawkish about inflation. Every sensible measure of core inflation is above 3% and either stalled above 3%, which is the upper range of the Fed's target, or actually rising. Given the most recent claims data, the most recent unemployment data, I think it's eminently reasonable for risk management purposes to cut by 25 basis points. I don't myself see the call to go for as far as 50. One of the big ironies is that Lisa Cook, obviously she's well to the left of Donald Trump, but on this specific issue of interest rates, generally speaking, people of her philosophy will tend to think that unemployment is more important than inflation if you've got to choose, which would mean you would think she would be one of the ones who'd be more likely to go along with a bigger cut. So it's similar to the kind of thing that often happens with the Supreme Court, that presidents want a particular candidate because of some particular issue at the time, and then discover that on other issues they diverge completely. That's why I don't see the Lisa Cook drama as being terribly relevant for this particular meeting. It's hugely relevant for the future.
But is the market pricing in, or at least is the market asking itself the right questions about what it means longer term?
Sorry, I should have answered that better. I think the market is working on the assumption that this meeting isn't affected, and I think it's also working on the assumption that one way or another, the really extreme attempt at a power grab that isn't going to happen. That between the Supreme Court and also potentially just with whoever is ultimately on the FOMC from next February, that they will not go along with the very forceful attempt by the administration to look for fiscal dominance, to assert dominance over the Fed. I think if you had a very clear sign that might not be right, which would most obviously be if the Supreme Court rules that Lisa Cook can go, that would be quite a big deal. And then obviously if the new FOMC sits and begins to suggest that it really is prepared to be a different FOMC that sees its mission as being one to keep borrowing costs low, that would again really shake confidence in the dollar, really make international markets worry. I think it's probably right that for the time being that is seen as on balance unlikely. They probably are underpricing that risk.
John, as always, thank you so much. My go-to person, first thing in the morning, John Authers, Bloomberg senior editor for markets and Bloomberg opinion columnist. He writes every day, and it's always a funny and brilliant read. Now, emerging market stocks poised for their longest winning streak in 3 months. The latest run of gains comes as traders ramped up bets of a series of cuts by the Fed. Well, we're now joined by Omotunde Lawal, head of EMEA corporate credit and emerging markets corporate debt at Barings. Thank you for joining us. There's just a lot going on. I mean, the day before the Fed probably cuts, how are emerging markets behaving right now?
We've had a good September so far. So emerging markets have had a good September. We're up something like 45, 46 basis points last time I looked in terms of where we are month to date. So we're having a very good month. But I just wanted actually to just comment on something very quickly that John mentioned around the Fed cuts and the Fed's dual mandate. You know, there is increasing chatter that this labor market coolness that is behind the need for wanting a bigger than a 25 basis point cut could be due to AI productivity gains. Yeah. That doesn't actually require the labor market input. So it's going to be quite interesting when we hear the sort of commentary that accompanies the Fed decision tomorrow, just to see actually, are they going to factor that in, and are we actually going to see bigger cuts coming through later? But I mean, EM markets are in the party as well.
On that, I mean, you know, John Authers had this great piece in saying, like, maybe they need a third mandate, right? Maybe we should look at the Fed and see what else is there in terms of social cohesion or something like that. Would it likely to be under this administration?
Possibly not. Possibly not. It just seemed quite that there's a strong willingness or strong desire from the Trump administration to just keep borrowing costs low. I think it's less about the inflation mandate or the labor market mandate. It's just really about stimulating that growth and just having borrowing costs low. So probably not. Or if that's a third mandate, then yeah, maybe.
So exactly, that could be a mandate, and then you know, to hell with the first two. Tunde, give me a sense first of all of how much you're expecting from the Fed. So is it 25 basis point cut, but then they go bigger?
Yeah, 25 is the consensus. I think if we see more than 25, then people start to worry and think, is there something I don't know? But 25, I think, is baked in. I think expectation probably generally is we should see another 25, 2 more 25 cuts into year end. So sort of taking it to 75 for the end of 2025. And I think that's what the market is pricing in. And generically for my asset class, I think rate cuts in the US are quite positive. You know, we see the investors likely to move from money market funds into riskier assets. EM tends to benefit from that. And, you know, the underlying fundamentals and all of that are good. So EM is very much in the party, as it were, as we start to see the rate cuts. But with this particular FOMC meeting, I think the focus is going to be around the commentary that accompanies the 25 bips when we get it. And then it's really about the board composition and the leadership and where do we go from there.
So what's your take on China? And actually, does a 25 basis point cut help or hinder China?
Well, the whole China debate, the U.S. cut in itself, apart from the general boost that it gives to all of EM, nothing specific for China. I think where the market is getting some euphoria from China is the positive noise that we're getting around. There's a TikTok deal, you know, Xi and Trump may speak on Friday, and we're getting closer to what seems to be the positive direction towards some sort of deal ahead of this November deadline. I think Besant has signaled that maybe they can extend that deadline beyond November if they need to. Those are the positive things that the market is taking into account. And you know, China in itself has its anti-involution policies that are going on. So to that extent where there's a bit more growth, there's a bit more sort of euphoria in the world, that's positive for the sort of products that the Chinese manufacturers and everyone is pushing out, because they're getting them into these other countries without having to undercut from a pricing perspective.
Does China need to stimulate their economy a lot more because of these pockets, real estate, you know, concerns or question marks about consumers?
Yeah, so we got pretty weak data yesterday from China, and you know, immediately you had the calls for we need more stimulus, we're going to get fiscal, we're going to get monetary. But it's to be expected. I think anti-involution is just, you know, it's doing how do you define it? It's trying to get more. It's using more resources for production without getting more productivity gains out of it, right? And so you see very clear example of it where the China EV market, where you're getting all these fantastic electric vehicles being produced, but it's a race to the bottom in terms of the pricing war, and so that in itself has knock-on implications in different parts of the supply chain. Suppliers don't get paid. Dealers are sitting on inventory that depreciates pretty quickly as soon as you put it on the forecourt. And buyers buy a car, they drive it off, resale values are plummeting. So there's no winners in it, and it's just a race to the bottom. And so from that perspective, you can see that the weak data was to be expected, because the supply side you're seeing it's the big coal industry, steel, aluminium. Those are the ones where you're seeing the sort of production numbers come off as the anti-evolution policies seem to be kicking in. And then on the demand side, you have the base effects from the trading on subsidies from last year. So there's a bit of weakness both on the demand and the supply. But as you say, real estate was quite weak. I think new starts and new home sales were down double digits, almost 20%. And so there is obviously expectation that we will see some sort of stimulus. There's got to be stimulus to stimulate a bit of the demand side. And then there's got to be some support for real estate. We did get some stimulus at the very end of August on real estate, so that hasn't quite fed through to the data we got yesterday.
Because it's always a bit of lagging.
There's a bit of lag in it.
So now, how much is there a rally left actually in emerging market assets?
Well, how long is a piece of string? It's all relative, isn't it? So right now, the spreads on our asset class, we're sitting around 190, which is about 4 or 5 basis points from quite post-GFC tights. And could we go tighter? Potentially, yes, because it's really about the sort of technicals around it. If you're getting US cutting rates and people are seeking higher risk, high yielding assets, there is the potential for more fund flows to come into asset classes like emerging markets. And if you look at the funds data as well, it is supporting that. EPFR data, which is predominantly retail, at the end of May, net flows into emerging market debt as an asset class was minus, I think it was minus 12 billion. At the end of Friday of last week, we were at plus 8.5 billion. So it's a round trip of about $20 billion of inflows in 3.5 months. That is telling you something. That is telling you that, one, people are forward-seeking higher risking assets. People are seeing the underlying growth potential within EM. And we've already spoken about this, that the bulk of EMs actually are not hugely vulnerable to all these tariff noise that we've had. So actually, you're getting paid quite decent yields there, something like an all-in yield of around 7% to be buying EMDs. So what's not to like there?
There you go. Thank you so much for joining us. So spotlight there on emerging markets with Omotunde Lawal, head of EMEA corporate credit and emerging market corporate debt at Barings. Now let's also bring you a developing story. In Israel has intensified strikes on Gaza City, with the military saying it has launched the next phase of its operation in Gaza. Army radio reporting that 2 divisions are maneuvering into the heart of Gaza City, which the military says will be encircled from all sides in coming days. Now, Israel has told civilians to leave, with the military stating that over 350,000 residents have left. Now, coming up, our exclusive conversation with Apollo President Jim Zelter on the future of investment-grade private credit and the outlook for Europe. That's next, and this is Bloomberg. Well, private credit's efforts to finance investment-grade companies is going to come down to its partnership with banks. That's according to Jim Zelter, president of Apollo Global Management, one of the world's largest alternative investment firms, with about $840 billion of assets under management. Zelter also sees plenty of investment opportunities in Europe as governments struggle to meet industrial spending demands. Well, he spoke to us exclusively.
This is the most unique period of time in Europe. For the first time in decades, I think there's the good thing about this administration is that the memo has been sent out about global growth and responsibility and accountability. And as a leadership in the countries around Europe are trying to figure out what that means for them, there's certainly a conversation that Apollo wants to be a part of, and we find ourselves being the recipient of a lot of dialogues and part of a lot of dialogue. So very exciting time. It's not a clear picture. And like usual, Europe has many different stories. in terms of the continent and each country what their objectives and needs are. But very exciting time for Europe, and we've been very public and pronounced about what our ambitions are, whether it's 100 billion in Germany or several hundred billion around the continent. We believe we're going to be a player in that dialogue.
So where do you see the best deals actually in Europe? And when you talk about dialogue, will that translate into actual money being spent in Europe?
Well, I think before you get to deals, around the globe right now there's this massive global industrial capex needs and global industrial renaissance, which is really the provision of capital for whether it's energy, former utilities, transmission lines, whether it's energy sustainability and the modernization of that, whether it's data centers. We find ourselves in a situation where, for the most part, corporates and consumers, our balance sheets are pretty solid, where governments are a bit more challenged. So I think there's a realization that there's a dramatic need for CapEx, and governments on their own are not the solution. And so, every country in Europe has a different objective in terms of their fiscal policies and their fiscal ambitions. And they have great ambitions, but a limited budget to provide that. So I think as the world of finance continues to evolve, certainly we've been quite active in Germany. Yep. We've been quite active in France.
Do you think that Europe will be just more competitive after the Draghi report? We talk about it, but have we seen anything concrete?
Well, our economist Torsten Slok had a nice review of the Draghi report a year in. And in terms of specific accomplishments, I think they've accomplished 11% of the objectives in there. And there's a lot still being discussed and debated, which is a little bit disappointing, or very disappointing. But I think in due course, more will be adopted.
Looking at different sectors, is enterprise software in a little bit of a bubble?
Well, when you look back in my career, whenever there was a period of time where there was an excess amount of capital funding in asset area, whether it was dark fiber in the late 2000s, whether it was shale in the 13 to 16 era in the US, or whether enterprise software the last 4 or 5 years, a lot of capital has gone into that business. Great companies were purchased at very high multiples, some not only double-digit multiples, but double-digit multiples of revenue. And so clearly, if you look at areas where between disruption and different economic growth vectors, that sector is one where there will be a greater dispersion between winners and losers. But I think that sort of highlights as I mentioned last week, it's interesting, in my career, the last 30 or 40 years, most CapEx in big industries went to companies that were either coming out of a different regulatory regime or a technology regime. Think gaming, think cable, telecommunications, maybe even transport with airlines, or others. And those were all non-investment grade companies. The companies that need the capital going forward are typically more investment grade counterparties. So that helps us because of our business model in terms of how we've funded our liabilities, not only through client capital from other sovereign funds and pensions, but also from the retirement services balance sheet.
Is there something else that you think is overstretched in terms of valuations?
Well, I certainly think with the capital going into data centers today, I think each one stands on its own economic merits, and determining if it's best to be a debt provider or equity owner, those are questions depending on structure and counterparty. But certainly, there's no doubt that the society will benefit from the broad growth of AI and data centers. We're all using it more often. It's just a question of who will be the economic winner. And I think that we're active in both the debt and equity, but certainly I think that as the capital needs are so massive, there certainly will be winners and losers.
What's your take on the UK specifically? It's a big week. The King is hosting the President. and we're expecting deals on the back of it.
Yeah. Well, I think, I'm not privy to any particular announcements, but when you think about what has gone on in the last several years in the UK in the US with the growth of data centers and other areas that private credit and private capital have funded, if you're the UK government, you have to have your shopping list, and attracting foreign capital along with industry and growth should be a great driver of economic growth.
Well, that was Jim Zelter, president of Apollo Global Management, speaking to us exclusively. Now, Swiss lawmakers voted against a second attempt to delay stricter bank capital quality rules to lift UBS's capital requirements by some $3 billion. Now, we're joined by Miriam Belezu, our Swiss finance reporter in Zurich. Miriam, so good to speak to you and have you on TV. So what are the likely options being considered at UBS?
So, Francine, we have a wide range, actually, of options, going from the smaller tweaks that UBS can do to something a bit more mega and tectonic. We're looking at smaller options, such as potentially just upstreaming. So the bank has already sort of baked in $5 billion, and there's a potential for more from Credit Suisse UK unit or from UBS's US subsidiary to be adding on to that number and reaching eventually the $26 billion. We're looking also at more UBS staying conservative and disciplined, as it's always been, and just getting to that number just organically by being just a bit more conservative in its kind of dividend and payout plans. And then there's some more, let's say, dramatic options, such as potentially downsizing the investment bank, which is a big focus. And this is something, bear in mind, that UBS had done in the past under Sergio Amotti, shortly after the financial crisis. And there's also an option to potentially carve out the Swiss business, which is also something that Credit Suisse was looking at doing just in the run-up to its collapse. And obviously, last but not least, would be in just relocating and doing that via M&A, potentially buying, let's say, a business in the US and then, relocating that way. So these are the kind of options that the bank is looking at. It's very broad, and no decision's been made just yet.
So, Miriam, how would these changes be received by Switzerland, but also by investors?
And it's a bit of a mixed feeling. I guess the relocation, some part of the Swiss government would probably rejoice that would rid them of a big conundrum. However, for the country, that would be a big loss. Obviously, UBS is the last remaining global bank that we have here. So it would be, and it's obviously core to the economy, core to Swiss identity. So that would be a disaster from that standpoint. And for investors, Cevian, which is the activist investor that holds 1.4% of UBS's stock, they've been vocal in saying that the company should leave.
Thank you, Miriam.
So
as always, Miriam Belezu there. Something to look out for. Our Swiss finance reporter there with the very latest from Zurich. Up next, Bloomberg Brief with Vonnie Quinn, and this is Bloomberg.